Hey, good afternoon, everyone. It is January the 27th. Can you believe we're here already? It's insane. Um, I wanted to put together a quick little video regarding debt consolidation loans and what those can do as far as freeing up significant amount of monthly cash that you're currently paying towards car payments, credit cards, student loans, you name it. We've all had to increase the cost of ownership or the cost of just getting by in this current high inflation environment. We're all there. And a lot of people have taken on significant credit card balances. They've had to, really stretch themselves pretty thin, and they're looking for some relief. Let's talk about how we can show you the benefit of using a debt consolidation loan. Even though the interest rates right now on the mortgages are higher, it still saves significant amounts of money, and it can ultimately be a net positive for your monthly nut going out the door. Let's take a look at it, shall we? So let's share. Debt consolidation. There it is. Boom. All right, you should be able to see this now. So what I've done is I've taken an average of 2 or 3 different clients that have done this in the last little bit. Let me just talk about what they've got. So in this particular circumstance, this is John and Jane Smith. I just put this together. Hi, John and Jane Smith, right? They've got 2 cars. So they've got a vehicle loan, they've got 2 credit cards, and then they've got a home equity loan. And the total of all these payments that they're paying, all these and the balances of this, they owe $84,000 between all these things, and they're paying monthly right now $2,780, right? Believe it or not, guys, this is not that crazy or out of whack. This is actually probably on the low side based on the scenarios that I've seen, which is insane, right? So currently, in this particular scenario, they've got an existing loan balance of $401,000. They owe $84,000, right? And then their monthly payments are going to be calculated as such. They currently have $1,928 principal and interest payment. They pay taxes and insurance and mortgage insurance of $1,152. Their installment debt, which is the car payments, that's $2,075. And then this debt is the revolving, that's the credit cards, that thing. What I'm proposing is a new loan of $3,229. They're going to still pay taxes and interest, but they're not going to pay mortgage insurance because it's going to go away because of their equity position, right? And well, you'll notice right here, 0, 0, 0. That's because all of the debts go bye-bye. And we're looking at a total payments that they're currently paying of $3,859. That drops down to $4,208. And that saves them $1,651 per month. Now, if they were, in this particular scenario, we can play with this. Let's say that they were going to say, we want to take all of the $1,651 per month that we're going to save, and we're going to put it back towards our mortgage. We're going to basically take that additional savings and put it back towards principal. That would shorten their term. They would save 12 years and 4 months off their mortgage payment, and they'd save 148 payments. Now, not everyone's going to want to do that. I get that. Let's say for the sake of argument, they're like, you know what? Let's keep $1,000, and then we're going to take the other the 651, and we're going to pay that towards principal. That saves you 6 years, and you save 72 payments. You're still ahead of where you would have been on your other loan. Well, let's just say, well, we don't need that much. Let's say 500, and we're going to put the 1151 back towards principal. Well, that saves 9 years, 11 months, almost 10 years, 119 payments. So you guys can see what I'm talking about here. It's back to 0. You guys can see what I'm talking about here in as much as this is dynamic. You can save thousands of dollars per month. Now, obviously, you're going to have to get your head around the fact that the interest rate on the equity on the new loan that you're going to pull out is going to be higher than your existing rate. In that particular circumstance, that interest rate on their existing loan was like 3.125, which is probably about right for a loan that was taken out over the last 3 or 4 years, right? Versus the new one today would be around 6.75. That's a significant increase. I'm not going to sit here and argue that it's not. But if you can save $1,650 per month, you're gonna at least pause to consider that, right? And the thing is, it's about the overall cost of living. It's not just your mortgage, right? Your mortgage is a big thing, but it's just one piece of your overall debt management, right? It's your overall debt to income ratio is comprised of not only that, but also your car payments, your credit cards, your student loans. A lot of people really feel like they're drowning in those, right? So if we can get those knocked down to 0, get the slate clean, you can save a significant amount of cash, get yourself out of debt, The only debt you would have would be your mortgage. You can turn around and accelerate paying the principal down with the savings and be in a much better position than you're in right now, just tapping some of the equity that's in your house already. It's just sitting there. So might not be perfect for everybody. I totally get that. And, everyone's going to have a different circumstance and have a different idea of, how they're going to manage their debt. It's at least worth having a conversation. So give me a call. If you have questions, concerns, issues, problems, you want to run scenarios, you're like, hey, let's look at this for me. I've got, some debt that I've taken on. Let's just at least look at it. I'd be happy to do it. I can do that in real time with you and I can share my screen, the whole 9 yards. So let me know. Good luck. God bless. I hope everyone's doing well, and I'll hopefully see you around the bend sooner than later. Take care.